This is my real face because I'm not feeling too well. Okay, so this video is going to be about company income tax, how to compute company income tax in Nigeria. You guys, let me apologize for any noise you're hearing. I live in the middle of a major market and I don't want to wait till night before I film this video. So please, I'll try and raise my voice. In company income tax, I'm teaching based on Finance Act 2020. Now we have the normal basis and we also have the other basis. Okay, basis here is what are you taxing? That's what base is about. What is the tax base? You know there's tax rate and there's tax base. So what's the base that you're applying your tax rate upon? So the normal basis is saying compute your tax based on taxable profit, the normal profit of the company. Now under the other basis, you have your minimum tax basis. I'll explain everything. This is just like introduction before solving a question. By the way, we're going to solve a November 2018 question. So you have your minimum tax basis, you have your dividend basis of computing tax, and we also have the turnover or revenue basis. So the minimum tax basis is basically telling you that compute a minimum tax, as in this is the minimum, at least, as in okereju. And for you to compute minimum tax, you must have computed the normal tax, right? So then you now compare it to the minimum tax. It must not go below a minimum tax. So I'll show you how to compute minimum tax. And for a company, yeah, let's talk about this minimum tax, well, because it's something that is very examinable. For a company to compute minimum tax, there are three conditions. The company must have been in business for not less than 4 years, right? The company must have been in business for not less than 4 years. So a company that has been in business for just 2 years, computing minimum tax, don't compute. So those are the small information the examiner would put in the question. When we read this ICANN question, you will understand. Then the second thing is that the company must not be into agricultural trade. Then the third thing is that the turnover of the company must not be less than 25 million. So once an annual turnover of a company, as in their gross revenue, is less than 25 million, maybe you just see a company with annual turnover of 20 million, just know that minimum tax is not there. So you must understand these laws. And how do you understand the laws? Is by constantly practicing. Okay, I know some of you already know these things, but you're just here for maybe explanation or better understanding. Now let's go to the dividend basis. There are some companies, for example, I'll paint a scenario so that you can remember. You're declaring a total profit or a taxable profit of 5 million. We can also see that you paid the dividend. You paid dividend to your shareholders, 10 million. Where did you get the dividend? So the tax authority at this point, they have the right to tax you on the dividend basis. So they will place the tax rate, the 30% or the 20%, as the case may be. You understand when we get to rate. They'll place it on the dividend you paid. Or you declared a loss of 4.5 million and you paid dividend of 10 million. How? Dividend is paid out of profit, except you paid it out of retained earnings. Even at that, they will use the dividend basis. Then the turnover basis is taxing the turnover. Very simple. Why would the tax authority tax the turnover? The normal thing is to tax the taxable profit, right? And I'll show you how to get to the taxable profit when we get to format. But sometimes some companies will say they made turnover of 200 million, and then by the time they finish netting all their expenses and taking all allowable expenses, maybe the taxable profit is so small compared to their turnover. So in that case, the tax authority has the right to tax them based on turnover basis. If the tax inspector probably feels like this company, so those ones are based on discretion of the tax authority. But the one that is so examinable is this normal basis and the minimum tax basis. And how do you know there's a minimum tax situation in a question? Is by this information, this 4 years, this agric, and this less than 25 million. And there's some kind of information they'll be giving you because minimum tax has a formula, right? So those formula, the variables you use to calculate the minimum tax, like gross revenue, paid up capital, once you start seeing it in a question, you know that there's minimum tax. No examiner will come and tell you directly that this is what you should do, right? So let's go to the rates. The rates of tax. Everybody knows that tax rates, company income tax rate is maybe 30%, but they have now done a breakdown into small companies, medium companies, and large companies. Okay, so for small companies, there are companies that their turnover is less than 25 million and below, yeah, and their tax rate is 0%. So if you see a question and they say the turnover of this company is less than 25 million or is 25 million, don't tax. The tax rate is 0%, but this company must file. You must file tax. Then for medium companies and companies that it is more than 25 million, but less than 100 million, and their own tax rate is 20%. So this is what the tax authorities have classified as medium companies. More than 25 million but less than 100 million, they file at 20%. Then the large companies are companies that are 100 million and above, right? So those ones file at 30%. We're talking of the turnover, or these values are the turnover. The turnover is the yardstick, can be the benchmark here. So they won't tell you this company is a large company, just see the turnover and then you know. Sorry, my neighbor is doing pounding. I don't know if you guys can hear it. So I really apologize for all the external noise. We've done basis now and the rate, and we are going to the format, so I have to wipe this board off. Let me start like this. What are you trying to achieve by doing the format? You are trying to achieve company income tax. So it's more like a step-by-step calculation on how to get your company income tax. Do you understand? So this is how to do the format. You write the name of the company, then you write computation of company income tax for so year of assessment. Okay, so you start from profit as per account. They would always give you the profit as per account in the question. Profit as per account. What does profit as per account mean? Profit as per accounting record. You know, accounting approach and tax approach is different. And the accountant in the company has already done a lot of concoction. They have already deducted a lot of things. Okay, let's start like this. How do you arrive at profit? Is it not your total sales, turnover, minus all your expenses? That's just the equation. Sales minus expenses will give you your profit, okay? But most times, the tax authority will always disagree with this profit, and then you have to do some adjustment to get the tax profits. Do you understand? So when you have profit as per account, what you do is to add back. Why is it called add back? Some people not call it add back, just add. But it's called add back because they've been deducted. So anything you're adding back, it was an expense. You add back disallowable expenses. So what are disallowable? Let's finish the format, then we'll explain. It's going to make more sense that way. You will less non-taxable income. You now have your assessable profits. Once you see your assessable profits, the first thing to deduct from it is your loss relief, right? Less loss relief. You deduct that. After your loss relief, you have your balancing charge. And what do you do to your balancing charge? You add it. Then after your balancing charge, the next thing is your investment allowance. And what do you do to investment allowance? You less it. Investment allowance. Can you hear children noise? So sorry. You less investment allowance. After your investment allowance, you have your capital allowance. And what do you do to your capital allowance? You less it. Capital. This one is a topic on its own. Immediately after this video, I'm going to post that, right? Because people asked me to do capital allowance video, so I'm going to do that. So you less capital allowance, right? So you have your total profit. What I like to call taxable profit. Actually, it makes sense. It's taxable profit because it's upon this figure, the figure you have here, that you apply your tax rate. Okay, total profit or taxable profit. But in the act, it's called total profit. So taxable profit. After that, you close it. But the next thing after here is your tax liability. Then you have CIT at applicable rates. Why applicable rates? Because you don't know whether it's a small company or a medium company or a large company, right? Remember the 0%, 20%, and 30%. So applicable rate, whatever the rate is, you get your CIT. Then you have your EDT, which is always at 2% of your assessable profit. And then you have that. And that's all. Let me explain what this format is. I said you start with profit as per account. So this profit is kind of unacceptable to the tax authority. That's why you're adding back disallowable expenses. Some expenses are disallowed, right? For example, depreciation. I'm going to put a list on the screen of disallowable expenses. Depreciation is disallowable because the tax authority has given you capital allowance. Capital allowance is just like depreciation. It's an allowance for capital expenditure. Depreciation too is more like an expense or an allowance that is like relieving you because you spent money, you spent from your revenue to buy a particular asset, maybe a big plant and machinery or some big assets. Qualifying capital expenditure is not everything that qualifies as assets. Why are you adding back? Because it has been deducted. Maybe the profit as per account, that is the profit as per account means the profit that the accountant calculated. Maybe it was like 100. To get to this profit, it has deducted the depreciation of maybe 20. Is your own duty as a tax consultant to add back that 20 so it can become 120. And what does this imply? This implies a higher tax liability. Another one is donations to unapproved bodies. Like you are donating to, there's a list of approved bodies that you can donate to. You can't just donate to any organization, you understand? So some donations are disallowable because this donation was an expense. It was an expense that was charged to arrive at profit. So you need to add back. That's why you're saying add back, right? Another common disallowable expense is bad debts, provision for bad debts, general, right? General, because some businesses do different things, and you know that provision for bad debt is an expense before arriving at your profit. So the tax authority is saying, come, what is the specific provision? The specific provision for bad debt, or the specific bad debts that you have incurred, is 4,000. That is what you can allow. Every other provision, like general provision, you just generalize that, my debtors will go bankrupt, and you just charge it. It will reduce the profit that is taxable. The essence of this add back line is to increase the profit as per account. Okay, stop hiding under expenses, because people hide under expenses to pay less tax, and that's why there's a revenue basis, there's a dividend basis, and all of that. So you're to less non-taxable income. There are some income that are not taxable. An example of non-taxable income is like profit you generate from selling an asset. So when you have that kind of profit, it's not in your normal course of business, right? There's always an explanation for every format or every rule. An example is profit on sale of property, less non-taxable income. When you do these two, you arrive at your accessible profit. Accessible profit is the profit that is now accessible to tax. It does not mean that that is what is taxable, because there's some certain adjustments, there's some certain allowances that the tax authority will give you. Immediately after accessible profit, you're going to less your loss relief. Maybe I'll do a video on loss relief, because it's also a whole branch or a whole topic on its own in taxation. Loss relief is relief on loss. Maybe you made a loss of 5 million last year, but this year your profit is reading like 15 million. That loss you made last year, you should recover from that loss. So they will give you that loss, they will deduct it. So after you less your loss relief, it has reduced your accessible profit. The next thing that should come to your mind is your balancing charge. Now, balancing charge is okay. Balancing charge and balancing allowance is under capital allowance. But let me explain what balancing charge is. Balancing charge is to be added. When you add it, it will push up your accessible profit again, right? So balancing charge is the profit you get from selling an asset. I said earlier that let's say you sell an asset for, or you dispose is the right word, you dispose a property of 45 million, maybe you dispose it for 50 million. There's a profit. That profit will be taxed though. Government, they will tax it. So that's why you're adding balancing charge. You can see that it's added. So to push up your accessible profit again. That one makes sense, right? The next that comes to your mind is your investment allowance. Investment allowance is also under capital allowance. Capital allowance is a little bit important. I'm going to do the video. So you have your investment allowance, and investment allowance is also under the topic of capital allowance. When a company buys plants, which is a qualifying capital expenditure, you have to grant 10% as investment allowance. So that you deduct that, and that will reduce your accessible profit. So some variables are increasing the profit, and some variables are reducing the profit. The next thing is capital allowance, you guys. Capital allowance. So capital allowance is the allowance that is given in lieu of depreciation. In your normal account, your management account that they prepare in the office, that the accountant prepares in the office, they charge depreciation. You guys know what depreciation is now. But when it comes to preparing taxation, you must knock out depreciation by adding it back and come and charge it as capital allowance, right? In most cases, it is favorable. As in, capital allowance rates, in most cases, they might be higher than what you even charge as depreciation. And in some cases, it will be unfavorable. But that is the standard. That is what the tax authority have said. So, your capital allowance, you less it, right? It's an allowance that is relieving you of the money you spent to buy an asset, right? So that's the last thing you will deduct before you get to your taxable profit. It's my board is muddled up. Somebody told me that your board looks choked up. I'm going to buy a new board. But that's if you give this video a thumbs up. As in, if you don't give this video a thumbs up, how would I buy a board? So after that, you have your total profit or taxable profit. Then you calculate your CIT at the applicable tax rate and your EDT at 2% of accessible profit, and that's all. Now let's go into question. Please, at this point, if you have any question, leave it in the comment section. Please let me know if you're watching. Are you an ICANN student? Are you a university student? So that I know the kind of things we're putting out. Am I doing lecture for university students or for people in the office? Which I'm not ready to do. Or for people that are doing ICANN or ATS, or let me just know so that I will know how to give you better value. Okay.